Welcome to Crypto Classroom, the #1 YouTube channel for learning about the latest trends in cryptocurrency and blockchain technology. At Crypto Classroom, our main goal is to equip our audience with the knowledge needed to excel in the dynamic and fast-paced cryptocurrency landscape. At the start of 2022, over $325 billion was wiped from the global crypto market, with the possibility of more to come. That's more than the market capitalization of car manufacturing giant Toyota. Many investors, both new and veteran, will be trapped in the falling market and unable to cash out without incurring heavy losses. According to data from Into the Block, 28% of Bitcoin investors and over 31% of Ethereum investors are out of the money right now, meaning the prices of both cryptocurrencies are now less than what they paid for them. For other assets like Cardano, more than 87% of investors are in the red. Today, we will be giving you 4 strategies that you can implement to not just survive the bear market, but thrive when we are on the other side. Number 1. Dollar cost averaging is your best friend. Do not blindly buy the dip, aka ape into it. Rather, use a dollar cost averaging approach. It's all too easy to be on the wrong side of a crypto trade when markets turn wildly volatile, but that doesn't mean you have to sit there and watch your portfolio plummet by the hour. Investors who have held back a reserve of fiat currency or stable coins, or have expendable capital in their bank accounts, will have the ability to buy the dip. This common phrase used throughout the crypto industry refers to the practice of buying up an amount of cryptocurrency whenever there's a significant bearish correction in the market. The theory is that if and when prices return to their previous highs, dip buyers will profit handsomely. This echoes stock trading legend Warren Buffett's famous proclamation, "When there's blood on the streets, you buy." While it is possible to buy the dip in a single trade, the most recommended strategy is to use dollar cost averaging, or DCA. This entails dividing your reserve funds into smaller chunks and trading multiple times over time. For example, let's say you have $1,000 in reserve funds. A good DCA strategy would be to break up the amount into 5 portions of $200 or even 10 portions of $100 and place trades using those smaller amounts. The thought behind this is incredibly difficult to know exactly when an asset has bottomed out or reached the lowest price before reversing. So instead of spending all of your money in one go, it usually works out better to buy a small amount and wait to see if the asset falls in price further. If it does, buy a little more, and so on. Doing this will typically garner much better results than if you had invested all your capital in a single trade. Unless, of course, you were lucky enough to go all in at the absolute bottom of the market, timing it perfectly. Number 2. Utilize indicators to find the best entry point. Technical analysis is the practice of predicting an asset's price movements based on chart trends, indicators, and patterns. With technical analysis, it is possible for some investors to use certain indicators to gauge when an asset has reached a bottom. Of course, no indicator is perfect, but they can often provide a strong signal when it's time to buy a dip. A popular method is to use the Relative Strength Index indicator, also known as the RSI. The RSI is a momentum oscillator composed of a channel and a line that oscillates in and out of it. There are 2 elements of this tool. Overbought. When the indicator line breaks out above the channel, the asset in question is considered overbought. In other words, overvalued, and usually signals that prices will fall back down soon. Oversold. When the indicator line breaks out beneath the channel, the asset in question is considered oversold or undervalued and usually signals that prices will rise soon. While these 2 signals can be used alone very effectively, they don't always accurately predict bottoms or tops, particularly on lower time frames such as the 4-hour, hourly, or 30-minute options. A better method is to employ the RSI divergence strategy. One thing to note about the RSI is that it usually follows a similar pattern to an asset's price, meaning when the price falls, the RSI indicator line also falls. However, there are times when the 2 lines move in opposite directions. This is known as an RSI divergence, and typically indicates the beginning of a trend reversal. To spot a bottom, you will need to see if the RSI line makes a higher high while the corresponding price makes a lower low. Ideally, the RSI line will be near or into the oversold region on a larger time frame, such as the daily, to signal a strong reversal opportunity. Number 3. Diversify your crypto portfolio. It's nearly impossible to know which of the 17,000 plus cryptocurrencies will recover the fastest or rally the most, just as it's nearly impossible to predict the true bottom of a bear market. Using DCA for a variety of crypto assets is one way to hedge your bets. This may entail reducing your trade sizes even further, but you'll lower your overall risk as a result. Of course, picking crypto assets at random and investing in them isn't enough. You should first conduct thorough due diligence on each crypto asset you intend to purchase, looking for the following. Identify the previous all-time high. Although no crypto is guaranteed to return to its all-time high, it can give you an idea of what sort of potential the asset has. Assess the past performance. Look at the asset's price history and see how well it has recovered during previous crashes. Does it correlate strongly with the rest of the market, or does it regularly outperform other leading assets? Previous performance is no guarantee of future price activity, but again, it gives you a rough idea of what might be possible. View upcoming roadmap announcements. One thing that can assist in an asset's recovery is the arrival of a major update or roadmap development. These can include things like a rebranding, a mainnet launch, or a new partnership. Number 4. Take a deep breath. This may seem obvious, but controlling your emotions during bear markets is not as simple as it appears. In fact, it's frequently referred to as the most difficult aspect of learning how to trade professionally.